Joining us now is Tom Hayes, chairman of Great Hill Capital. And Tom, when we take a look at what we've seen from the earnings results so far, most companies are beating what the street was expecting. Are earnings as strong as what you wanted to see at this point with the market currently at its valuation?
Yes. At the beginning of the quarter, the expectation was that earnings were going to come in negative. Again, 4 quarters of consecutive negative growth. And what's taken place is now that we're at 70 basis points of positive, so we broke the streak of 3 negative quarters of earnings growth, and that's very constructive, 71% beat rate actually as of today. And the key is going to be looking forward, though. I think to your point is, are we ahead of ourselves a little bit here? Earnings estimates for 2020 came down a little bit this week, so from 177.51 to 176.47. Which implies at these levels a 19 times forward earnings multiple, which is very high. The last 5 years has been 16.7 times earnings. So we have a little work to do, and in order to sustain this rally, we really need to see increased earnings. And the bad news is earnings have come down and the multiple's high. The good news is it's largely attributable to Boeing. In the last 60 days, Boeing's earnings have come down about $16. So the FAA last week came out and said things are going a little bit better than expected. If that gets back online sooner than expected, we're going to bring back $16 of earnings towards the back half and maybe a bit sooner, which means the multiple would immediately go back down from 19 down to about 17, which is in line with the 16.7 times average.
Well, Tom, when we talk about Boeing, lots of talk there just in terms of how it will impact U.S. growth, economic growth this year, just in terms of how big of a worry that will be. As you try to assess the situation, just in terms of how crucial that is to U.S. economic growth, how do you see that playing out?
Yeah, it's critical, but the good news is because it operates in a duopoly situation, is once it's back on track and the FAA gives the go-ahead, the market's going to look through that. So it's going to immediately apply the earnings. The backlog, they don't have to go knocking on doors for customers. It's immediately right back in the game, and that's going to bring that online. So I think what you're seeing here is a number of people were caught off sides with coronavirus. So this rally here could extend for a little bit, even though we're a little bit overdone, maybe another couple of weeks, catching the people off sides. And then we're going to focus on earnings. And you're probably going to see a little bit of guidance start to come in a couple, 2-3 weeks out, saying Q1's a little bit soft and people taking down guidance. And that's when you'll get your normal little pullback, normal consolidation as things set up for the back half of the year, getting the earnings power back from Boeing, and we can move higher into year end.
Tom, you mentioned the coronavirus just in terms of how the market has reacted. At least investors have largely been able to shrug off any concerns just in terms of how it could impact the global economy. Do you think the risk as it pertains to the coronavirus on a market level is starting to wane at this point, or has already waned?
Yeah, I think, if you look back to 1980, I was on a couple weeks ago, the average return, we've had 12 epidemics, so the average return 30 days out is about 44 basis points for the S&P 500, 3 months out is about 3%, and 6 months out is about 8%. So I think people started to digest that. It was an initial shock, you had the pullback, and now people are saying, okay, the rate of new cases is going down. We've got 2 drugs that look like they might be working with Gilead and AbbVie, so the fears are allayed a bit.
When you are trying to figure out what to buy in this market, a lot of the names look to be a little expensive, at least at this point. What are you favoring? Yeah,
so we've put out a number of notes. We've been trimming back a little bit on the stocks that have run. We're up 19% off the August lows. We were calling for a melt up in our notes then. On the S&P, we're up 26% on the NASDAQ, so that's a huge run. We've been trimming back the names that have moved tremendously off of that August low, and we've been starting to leg into some deep value, which no one wants to hear about, but you had a previous guest, the exploration and production subsector. And the reason we're doing that on a long-term basis is because it's trading down to great financial crisis levels, and the top 30 weights, if you look at the earnings power, are up 150% estimates for 2020 relative to when it was trading, but it's trading at the same level. So we like that deep value. We expect that a number of them, 10, 15%, will go bankrupt, so you buy a basket, and the ones that are left 3, 4, 5 years out can be up to 2x, 3x.
All right, Tom Hayes, thanks so much for stopping by.
Thanks so much for having me.
Well, straight ahead, one of the thousands of passengers